Hello, everyone. It is Thursday, March 18th, 2021. I'm John Kosar of Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important and influential charts and data series for the upcoming week. Number 1, the benchmark S&P 500 is hovering just above tactical support. And here's that chart. The last time I did a Your Daily 5 was February the 23rd, so just a little short of a month ago, and I was talking about the S&P 500 testing the support level, which comprises the 50-day moving average, which you can see in blue. Many people look at that as the tactical trend or the minor trend, and also the trend line off of the March 2020 lows that you can see here in pink. And I was talking about the Pavlov's dog syndrome of the market lately. You get down to support and the bell rings, all the bulls rush in and off you go. And that's kind of what happened on January 29th. So that's what happened this time as well. Just within a few days after I was with you on February 23rd, we came down and tested that support on March 4th. And on March 5th, we had a big upside turnaround, and we're off to the races again. So that support is now at 38.74 to 38.55. And even though we've had this explosive rally at the beginning of the month, we're only about 2.5 to 3% up above that support as we sit right now. So that means if the market is still good, if this uptrend is still intact, this is where we should get off the dime and we should make a serious sustained move up above the February 16th high and up and away to new all-time highs. Number 2 is market internals. Our Asbury Six is positive. I put a lot of emphasis, our shop puts a lot of emphasis on market internals because the market is different than it was 5 or 10 years ago. Algorithmic trading is by and large most of the volume every day, and a lot of that is just a lot of up and down noise. The market is up today by 30, it's down 40 tomorrow, it's up 50 the next day. So we built the Asbury Six to kind of be a lie detector for the market, and what it does is we have back tested 6 different metrics, only one of which has to do with price, and we did that on purpose just because of what I just said, but we back tested 6 different metrics to look at what I'd call secondary indicators: volume, corporate bond spreads, asset flows, market breadth, to try to indicate what's a real move and what's just a head fake that's going to be gone in 2 days. So right now, the Asbury Six has been positive since March the 11th. And you could see, this is updated every day in our research center. And if it's green, it's positive. If it's red, it's negative. And we include the date that it either turned positive or negative. So you can see right now, 5 of the 6 are positive. And only 1 is negative right now. It's corporate bond spreads is negative since 3/1 or March 1st. So I tend to look at this model and lump it in with the support level. So we know we've got support 2.5 to 3% underneath the market in the S&P 500, and we know that the Asbury Six is positive. That means this is where the next leg higher should go in terms of price and in terms of the market's internal health, as long as everything is good, as long as everything is healthy, as long as the market's healthy. This is the spot. We can't see the future, and nobody can. So the next best thing that we could do is know where the important spots on the chart are and know what the internal condition of the market is as it tests those spots. So that's kind of where we are right now. So we know if the market's good, it's got to be good from right here, from right on top of that support, and this is where we should go on to make new all-time highs. If something fails here, we'll see it in 1 of 2 ways. We'll see the Asbury Six turn negative, and that would be 4 or more of these would go in the negative category, and or we break through that support level in the S&P 500. If both of those happen, that tells us we're in a correction, And now we start to remove risk from the market. Number 3, another one of our models tells us where to be when we're in a risk-on condition. We're in risk-on status. And we call that our SEAF model, S-E-A-F, and it measures investor asset flows through the 11 sector spiders of the S&P 500. So we check this in 3 different time frames: trading, which is 5 days, tactical, which is 21 days, and strategic, which is 63 days. And we are looking for trends in percentage of asset flows in to these sectors and percentage of asset flows out. And what this model has been showing us, and I actually mentioned this in the last year Daily 5 we did back in February, is that on November the 12th, we saw a trend through our SEAF model that there was asset flows going into financials and energy. Those 2 trends are still intact. And since then, financials have risen by 31% and have outperformed the S&P 500 by 18%. Energy has really exploded. It's been up by 57. It's up by 57% since November the 12th, outperforming SPX by 41%. The S&P 500 has only been up by 11% in that same period. The other thing this model tells us is where the money's coming from. It's going into financials and energy. So where's it coming from? It's coming from consumer staples as of November the 25th, healthcare as of December the 4th, and technology since 2/25 or Feb 25th. This is where the money is coming from. So when we're putting money to work for clients, or we're putting research out for clients and showing them what the dynamics of the market are, this says to avoid staples, healthcare, and tech. Again, and we'll talk about tech a little bit more in just a moment. And the flows continue to go into financials and energy. Until that changes on our SEAF model, we are going to continue to be overweight financials and energy. Here's chart number 4, relative performance. Beware of weakening tech. And what we have here in the upper panel is a chart of the NASDAQ Composite Index and its 50-day moving average. Again, minor trend proxy in blue. And then we have in green the March 2020 uptrend. Back on February 23rd, which was the last Your Daily 5 that I did, I used this same chart and pointed out that on that day, the relative performance line between the comp and SPY actually broke through its 63-day moving average. And I stated that that looked to be the beginning of a period of strategic relative underperformance by tech. That's important because tech typically leads during a bull market. Tech typically lags during a sideways market or during a bear market. So since then, interesting what happened. We came down, underperformed to February 25th. We came right up and kissed that line on March the 1st, and now we're underperforming even further. Meanwhile, unlike the S&P 500, we've actually broken through this support level based on the March 2020 uptrend line and the 50-day moving average. And now we're coming back up to it as an overhead resistance area, which is at 13,337 and 13,418. That level is currently being tested. If the comp fails to get back up above this level, for more than just a few hours during the day or more than a day or so, and we continue to underperform here, it's going to be increasingly more difficult for the S&P 500 to maintain its support line that we looked at 4 slides ago back in number 1. So pay a lot of attention here to the comp. Without tech, it's very, very difficult. It makes it a lot more difficult for a broad market uptrend to sustain itself. Finally, got to look at interest rates right now. Very interesting what's going on here. We're going to look at a chart of U.S. 10-year yields, what appear to be making a secular trend change. Here is the weekly close in the yield of the 10-year note going back to 2012, along with its 52-week moving average. which is 1 year, and its 13-week moving average, which is 1 quarter. Look what's happened here. This 147 to 137 was a major area of yield resistance that actually goes all the way back to the end of World War II. Yields are also trading around this 145 or 150 area. So what we've done is we've blasted through there, and now we're testing 170. We're actually edging above 170. We're about 1.73% as of this morning in the 10-year. That suggests to me that we're going to continue to see these yields go higher and move to the next level, which was 2.05% based on the low that we made back in September of 2017. Why I think this is important is with stocks kind of sitting on support and trying to begin the next leg up, now we've got another chip on the scale, so to speak. There's been rising inflation expectations. A lot of commodity prices, most commodity prices have been rising. The dollar's been weakening. And now we see a spike in benchmark long-term U.S. interest rates. All of this suggests the market is getting a little concerned about inflation. If that is the case, that's another potential drag on the market here. So there you have it. Watch that support in the S&P 500. Pay attention to the relative performance of tech, and it should be an interesting several weeks coming up. Thanks for watching, and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.